we're going to work brief exercise 12.3 from chapter 12. Let's read the problem, understand what's involved, take some notes, and then solve the required items. So Takamoto Corporation borrowed $60,000 on November 1st, 2025 by signing a $61,350 3-month zero interest-bearing note. We're asked to prepare Takamoto's November 1st, 2025 entry, the December 31st, 2025 annual adjusting entry, and the February 1st, 2026 entry. Let's take some notes. So the borrower is Takamoto Corporation. So we are acting from the standpoint that we are Takamoto. The amount borrowed is $60,000 in cash. The date of the note is November 1st, 2025. The amount due is $61,350. The term is 3 months, and the interest rate is 0%. So let's talk through these items. We mentioned Takamoto borrowed $60,000 in cash on November 1st, 2025. We're told it's a 3-month term, so we know that's going to mature 3 months later on February 1st, 2026. So 2 of those months are in 2025, November and December, and then 1 month of the loan is carried in January 2026. The $60,000 borrowed requires a repayment of $61,350. So even though the note carries 0% interest, there's still a time value of money, and there's a cost to borrowing debt, to borrowing this cash. And that cost to Takamoto is $1,350. The difference between what was borrowed, the cash inflow is $60,000 versus the total cash outflows, $61,350. So that additional $1,350 represents the cost of the debt, the cost of borrowing this money. And therefore, it is implied that it will be recorded as interest expense. So let's take a look at how we record that as we go through the various journal entries. So the first one we're asked to complete is November 1st, 2025, the date the cash was borrowed. So we will debit cash for the amount received, which is $60,000, skip a line, and we will credit the corresponding notes payable. It's just one, so we'll call it notes payable. And the amount that is due in 30 days given to us in the problem is $61,350. So the difference between those amounts, we're going to record on the date we borrow the money as a discount on notes payable. And that's the $1,350. So now we have a complete journal entry. So if we stop on November 1st, 2025 at the end of the day, and Takamoto examines their financial statements, they see that they've gotten cash of $60,000. However, they owe $61,350 when the note matures in 90 days, in 3 months. That difference represents the discount that will be amortized to interest expense over the term of the loan. That is the implied cost of borrowing this money. You got $60,000, but you have to repay $61,350. The difference is the cost to borrowing that money. And as we know, the definition of cost of money is recorded as interest expense. So throughout the term, we're going to take this $1,350 and amortize it through interest expense. So the second part asks for the December 31st, 2025 adjusting entry. So let's see what that looks like. So when we're adjusting something, we know we're going to record either an interest or a revenue item. And because we're dealing with debt, it's going to be related to the interest expense. So we will debit interest expense, and we will credit this discount on notes payable as we amortize that across. So let's take a look at this discount on notes payable. We know the total amount that's in the balance, the total balance of that account is $1,350. We also know that the term is 3 months. So if I divide that by 3, I can get a monthly amount to amortize the discount towards interest expense. So the next question I need to ask is, how many of those months are in 2025? There's 2, November and December. So I'm going to amortize the $1,350 over the term of the loan, which is a 3-month loan. So divide it by 3. And then each month I will record this amortization. And there are 2 of those months, November and December, that need to be captured in the 2025 financial statements. And that amount is $900. So my interest expense is the same $900. I will debit interest expense for $900, which is 2/3, 2 months out of the total 3 months of the loan term in fiscal year 2025. Therefore, the cost of borrowing that $60,000 is captured in the portion of it, at least, that applies to 2025 is captured on the income statement for 2025. Then we move to the final part of the problem, which wants the February 1st, 2026 entries. Let's start with the amortization of the final piece of the discount on notes payable. So just like we did in December, we're going to record some interest costs. I'm going to add this in here. This is for November and December, and this interest expense will be for January. And we will record a credit to the discount on notes payable. So the calculation that we performed above was to take the $1,350, divide it by the number of months that the term of the loan is, which was 3, times the number of months that we're looking to amortize. Here, we're only amortizing 1 month for January, and we arrive at $450. Therefore, the corresponding interest expense is also $450. If we look at these two together, we can see we did $900 at December 31st to capture November and December, plus we did $450 to capture January, gives us the total of $1,350. So the entire amount of the discount on notes payable, $1,350, is amortized in these 2 journal entries. So the balance is now 0. Now we need to pay off the loan. So also on February 1st, we will debit notes payable. How much do we owe? The balance of notes payable is $61,350. So I will debit notes payable for $61,350, and we'll credit cash for the same $61,350. Now recall that the difference between what we borrowed, $60,000, versus what we have to repay, $61,350, is always known as interest expense. The interest expense could have been stated, and they might have had to pay interest every month of $450, or they said, well, we'll loan you $60,000, but you have to pay us $61,350 back. And so that difference represents the time value of money, the cost of borrowing money, and therefore it's all captured, it's all cash flowed on February 1st. However, GAAP says we have to match the expense and the time period in which it was incurred. So therefore we match the expense, $450 per month, over the term of the loan. 2 of those months are in 2025. 1 month is in 2026. And this concludes the requirements to solve for problem brief exercise 12.3 from chapter 12.